8 episodes, 1 architectural thesis. We began with jurisdiction selection, the foundational decision of which sovereign you elect as your primary fiscal residency anchor, and why that decision cannot be made on lifestyle criteria alone. We moved through the construction of holding structures, the sequencing of asset migration, the role of treaty networks in providing defensible transfer pathways, the selection and mandate of institutional fiduciaries, the operational continuity protocols that sustain the structure across generations, and finally, in our last episode, the strategic logic of why political risk is a priced asset that the market continues to systematically misprice against the interests of private capital. If you have followed this series in sequence, you now possess a jurisdictional intelligence framework that the overwhelming majority of high net worth individuals and a significant proportion of the advisors serving them do not have. You understand the common reporting standard not as a compliance burden, but as an intelligence layer that your structure must be designed around. You understand that unrealized capital gains exposure is a live, active risk in multiple G7 legislative pipelines. You understand that fiscal residency is a sovereign claim, not a postal address. What you now face is not a knowledge gap. It is an implementation threshold. And crossing it requires something that no series of episodes can provide: an institutional mandate. Let us be direct about the advisory environment most of your viewers are operating in, because the gap between what this series has described and what your current advisory team is equipped to deliver is in most cases significant. Advisory fragmentation is the dominant condition of private wealth management at the institutional threshold. It describes a structure in which a domestic tax attorney manages one dimension of your exposure, an accountant manages another, a family office or private bank manages a third, and none of these advisors are communicating with each other across a unified architectural mandate. Each advisor is optimizing for their own domain. None of them are responsible for the structure as a whole. The domestic tax attorney is not licensed to advise on Cayman Islands foundation law. The accountant is not tracking the BEPS Pillar 2 minimum tax proposals moving through the OECD working groups. The private bank relationship manager is not running jurisdictional stress tests on your fiscal residency position against the legislative pipeline in your legacy sovereign. This is not incompetence. It is the natural consequence of a retail advisory model applied to an institutional problem. The sovereign shelter cannot be built by a fragmented team optimizing locally. It requires unified architectural oversight, a single mandate that holds the entire structure accountable to a coherent jurisdictional strategy. We must address the psychological cost of advisory inertia, because it is the most common reason structures fail before they are even built. When you present an institutional-grade concern, such as the risk of retroactive unrealized capital gains, to a fragmented, retail-focused advisory team, they are incentivized to provide a response that maintains the status quo. They will label the risk as speculative, unlikely, or manageable under current rules. This is not necessarily malicious, but it is deeply dangerous. It is the natural behavior of an advisor whose mandate is limited to a single domain. If they acknowledge the structural reality of the threat, they acknowledge that their own scope of service is inadequate to protect you. Consequently, advice you receive is filtered through the advisor's need for professional self-preservation. You are being told what you want to hear to keep the current relationship stable, while the structural risk to your balance sheet continues to compound. In an institutional framework, the advisor's job is not to comfort you, it is to identify the exposure you are currently blind to. If your advisors are not challenging your current structural assumptions, if they are not pushing you to consider the worst-case legislative scenario as a primary planning constraint, then you are not receiving advisory services. You are receiving narrative reinforcement. And in the sovereign landscape, narrative reinforcement is an expensive luxury you cannot afford. There is a straightforward diagnostic for assessing whether your current advisory structure is retail or institutional. Ask your advisors 3 questions and evaluate the precision of the responses. First, what is our current exposure to common reporting standard, reporting across all jurisdictions where we hold assets or maintain fiscal residency? And how does that reporting map to our beneficial ownership disclosure posture? Second, If our primary sovereign implements an exit tax on unrealized capital gains within the next 24 months, what is our current structural position and what is the repositioning sequence that does not trigger a taxable event? Third, who is the single point of accountability for the architectural integrity of our structure, the person who holds the unified mandate across tax, fiduciary, legal, and jurisdictional dimensions? If your advisors cannot answer the first two questions with technical precision, you are being served by a retail team managing institutional exposure. If the answer to the third question is silence, or if it produces a committee rather than an individual, you do not have a sovereign shelter, you have a collection of advisors. That distinction will matter enormously when the political environment moves faster than your advisory team can coordinate. Inaction is not a neutral position. In a BEPS-compliant, common reporting standard world, doing nothing is an active decision to accept every repricing your legacy sovereign chooses to impose. The cost of waiting is compounding. The window is not permanent. The sovereign shelter is not built for everyone, and it is important to state this directly, because clarity about the right client is a precondition for delivering the right outcome. The institutional client is not defined primarily by asset threshold, though there is a practical minimum below which the architecture does not generate sufficient structural return to justify the implementation cost. The institutional client is defined by a set of behavioral and strategic characteristics. They have already concluded, not suspected, but concluded that their legacy sovereign's trajectory represents a structural risk to their capital and their personal agency. They are operating at a scale and complexity where advisory fragmentation is already producing material costs, whether through missed optimization, misaligned structures, or exposure to risks their current team has not identified. They understand that the sovereign shelter is a long-duration commitment, not a transaction that is completed and filed, but an architecture that requires ongoing institutional stewardship. And critically, they are prepared to operate with the fiduciary discipline that institutional structures demand, the transparency with their own advisory team, the operational rigor around substance requirements, and the patience required to build correctly rather than quickly. If those characteristics describe you, the conversation that follows this series is the right next step. The private advisory engagement begins with a single structured session, the Sovereign Shelter Briefing. This is not a sales conversation, it is a diagnostic. In that session, we conduct a jurisdictional audit of your current structure, your fiscal residency position, your asset holding architecture, your fiduciary mandates, your common reporting standard and FATCA exposure, and your unrealized capital gains risk profile across all jurisdictions where you hold material positions. We identify the specific gaps between your current structure and the institutional threshold, and we determine whether the sovereign shelter architecture is the right instrument for your situation. Because if it is not, we will tell you that directly and point you toward what is. For those where the fit is confirmed, the engagement moves into architectural design, jurisdiction selection, structure sequencing, fiduciary mandate, and implementation timeline. The engagement is not open-ended. It is bounded, sequenced, and outcome-specific. Every phase has a defined deliverable. Every decision has a documented rationale. This is what institutional architecture looks like at the advisory level, and it is precisely what advisory fragmentation cannot produce. The transition from an advisory engagement to an institutional mandate requires a clear understanding of the jurisdictional friction model. This is the final diagnostic gate. When you move to an institutional architecture, you are intentionally introducing friction into your life. Substance requirements, fiduciary board approvals, and mandatory disclosure protocols that did not exist in your previous consolidated structure. For the retail investor, this friction is perceived as a cost to be minimized. For the institutional architect, this friction is the primary instrument of defensibility. It is the mechanism that forces a sovereign government to engage with your structure at a treaty level rather than an administrative one. It is the barrier that ensures your residency is not just an address, but a provable, auditable fact. If you are looking for an engagement that makes your life easier in the short term, you are looking for the wrong outcome. The sovereign shelter makes your life harder in a technical sense. It demands more documentation, more oversight, and more structural discipline, because that is the exact cost of being untouchable. You are trading administrative ease for sovereign agency. If you are not prepared to manage that friction, the architecture will fail, not because the structure was flawed, but because the operator was not ready. The sovereign shelter is not a one-time implementation. This is the commitment that distinguishes institutional clients from transactional ones. And it is the reason the advisory relationship is structured as an ongoing mandate, rather than a project engagement. The jurisdictional landscape is not static. BEPS Pillar 2 implementation is ongoing. Common reporting standard participation is expanding. Fiscal residency rules are being actively rewritten in multiple jurisdictions simultaneously. The legislative pipeline for unrealized capital gains taxation is live in the United States, Canada, Australia, and across the Nordic bloc. New bilateral tax information exchange agreements are signed and ratified on a continuous basis. A structure that is correctly positioned today may require repositioning within 18 months if a key jurisdiction shifts its legislative posture, and that repositioning, if executed reactively rather than proactively, carries exactly the kind of taxable event and beneficial ownership disclosure risk that the structure was built to manage. The institutional mandate means your architecture is under continuous review by advisors who hold a unified responsibility for its integrity. It means early identification of legislative risk and proactive repositioning before the window closes. It means the structure is never caught flat-footed by a sovereign that has already moved. That is not a premium service. That is the minimum viable standard for institutional-grade jurisdictional architecture. The briefing is now complete. You have the framework, you have the criteria, you have the diagnostic tools to assess your current position against the institutional standard this series has described. What remains is a single decision. The link below this video accesses the Sovereign Shelter Briefing, a private structured session with the advisory team that built this architecture. It is the entry point. It is not a webinar, not a newsletter, not a discovery call. It is a working session with a defined diagnostic output. If you have watched this series and recognized your own situation and the gaps we have identified, the advisory fragmentation, the unquantified fiscal residency exposure, the unrealized capital gains risk, sitting unaddressed in a structure that was designed for a different era, then you already know whether this conversation is the right next step. The architect has finished the briefing. The question now is whether you will build. Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.